Welcome back to Talk Tickers. If you're tuning in, you aren't looking for the headline. You're looking for the story behind the numbers.
Exactly.
We are the place for professional earnings call summarization. We strip away the corporate jargon, and we hand you the raw signal. Today, we're focusing on a company that was supposed to be in the penalty box.
Right.
But somehow, they just won the game. F5 Inc., ticker of FFIV.
And if you were watching the tape leading up to this print, penalty box might be a little too kind. The mood was grim.
Grim is the right word.
Yeah.
Let's set the stage for everyone because the context here is everything. Going into this Q1 earnings report, F5 was facing this massive wall of worry.
Oh, yeah.
Back in October, they disclosed a security incident. Now, for a company that sells security, that's usually death sentence, or at least a quarter or two of misery.
The narrative was totally baked in. The street was expecting customers to pause orders, churn to spike, and for management to spend this entire call just apologizing.
That was the bearish thesis in a nutshell. The market was bracing for a miss. They were ready to just punish this stock.
But then the numbers hit the wire.
And honestly, I had to refresh my screen. I wanted to make sure I was looking at the right ticker.
Me too.
It wasn't a cleanup operation. It was a blowout. A complete reset higher.
It completely dismantled the bearish argument. Instead of a disaster, we got this massive beat, a raised outlook for the full year, and this is the part we really have to dig into, a shocking resurgence in what we call heavy metal hardware.
Oh, we are definitely going to get into that hardware piece. It defies pretty much every trend we've talked about for the last 5 years. But first, let's just look at the scoreboard.
Right.
The market reaction was violent in a good way. Shares popped, what, 10 to 12% in after hours?
Yeah, hovering right around $299. That is a massive repricing event.
It's the sound of institutional money having to admit they were wrong.
Exactly.
So let's look at the headline numbers that forced that admission. The street was looking for non-GAAP earnings per share of about $3.65.
$3.65. F5 posted $4.45.
$4.45. I mean, that's an 80-cent beat.
In this environment, where analysts are scrutinizing every single penny, beating by 80 cents is huge. It just shows operational leverage that nobody thought they had.
And it wasn't just bottom line. It wasn't a case of financial engineering either.
No.
Revenue came in at $822 million against a consensus of $756.
That's 7% growth year over year.
But here's the thing that gets me. The profitability, gross margins were 83.8%.
83.8. Those are software level margins on a business that still ships physical boxes.
And operating margin hit 38.2%, up 80 basis points from last year.
And I want to highlight something else, something that tells you what management really thinks.
Okay.
They didn't hoard cash during this quote-unquote crisis quarter. They went out and bought back $300 million of their own stock in Q1.
That is bold. Buying back stock right after a security breach.
It signals supreme confidence. It's them saying, we know the market has overreacted and we're going to take advantage of the discount. And judging by that after-hours move, they timed it perfectly.
Okay, so the numbers are great. Beat and raise. But we need to understand why, because the story here is complicated. Let's unpack the first big theme, the security incident, or maybe the non-event.
This is the elephant in the room that turned out to be a mouse. Like we said, the fear was that the breach from October would just freeze sales.
Right.
But on the call, the CEO, Francois Lecaudonu, he was categorical. He confirmed there was minimal demand disruption.
I have to pause you there. That sounds like standard corporate spin, doesn't it? Oh, we got hacked, but it's fine. Everyone is fine with it. Did customers actually buy that?
It's a fair skepticism. Usually that kind of spin just melts under scrutiny. But here, the data actually backs them up.
How so?
Well, the management team said they handled over 9,000 additional support cases during the incident. And here's the key metric. 50% of their customers patched their systems immediately.
Okay, that is fast for enterprise IT, but I'm still stuck on the relationship side of it. How do you tell a customer we put you at risk and come out the other side with more business?
It comes down to trench warfare. When the breach happened, F5 didn't hide. They mobilized. They were on calls directly with CISOs, the Chief Information Security Officers, helping them patch, helping them secure their environments. Management literally described it as a relationship strengthener.
That feels so counterintuitive.
But think about it this way. If a vendor hides during a crisis, you fire them.
Sure.
If a vendor is in the foxhole with you, sweating the details and helping you survive, you end up trusting them more. It gave F5 this rare chance to demonstrate exactly how critical they are.
So they're not a commodity. They're the plumbing.
They're the plumbing, and by fixing the leak right alongside the customer, they prove their value. The security hangover is, for all intents and purposes, gone.
So the crisis forced deep engagement, which led to sales. Okay, I'll buy that for now. But let's move to the second theme, which I'm having a much harder time with. We're calling this the hardware renaissance.
This was the biggest shock of the call for me.
The numbers are just staggering. Systems revenue, that's the physical hardware, the big metal boxes you rack in a data center.
Yeah.
It was up 37% year over year. Meanwhile, software revenue was actually down 8%.
Correct. Down 8.
Hang on. For a decade, the entire investment thesis for tech has been hardware is dead, everything is moving to the cloud, everything is software.
Right.
Is F5 telling us they're winning by going backwards? Is this sustainable, or is it just a blip before everyone goes back to AWS?
It's not a blip, it's a structural shift. We're seeing this trend called repatriation.
Repatriation, as in bringing the data back home.
Exactly. For years, the default move was lift and shift to the cloud. But companies are looking at their cloud bills now and, they're having a heart attack.
Because of the egress fees.
Egress fees, storage costs, compute premiums, it all adds up. Management highlighted a global technology OEM that repatriated massive amounts of IoT data from the cloud back to on-premise data centers. And they did it for one reason: to run AI analytics.
So it's a cost decision. It's cheaper to buy the condo than to rent the hotel room forever.
Precisely. But there's also a physics problem here. When you move that much data back on-prem, you create a huge traffic jam at the front door of your data center. You can't handle that kind of high-throughput ingestion with a lightweight software load balancer. It just chokes.
Why not? Why can't the software handle it?
It's about dedicated processing. General-purpose CPUs, the kind that run software load balancers, they're great at multitasking, but they aren't fast enough for these massive specialized data streams. You need ASICs.
Application-specific integrated circuits.
You need heavy metal hardware that does one thing: move data incredibly fast without latency. And that is F5's big IP hardware.
So if you're building an AI factory in your own data center to save money on cloud bills, you need industrial-grade pipes to make it all work.
That's it, exactly. And that is why systems revenue is exploding. It's not that companies love buying hardware, it's that they physically need it to make the economics of AI work.
Which leads us perfectly into the third theme: real AI revenue. Because everyone says they're an AI play, but usually it's just, vaporware.
Right.
F5 claims they're actually cashing checks.
They added as many AI customers in Q1 as they did in all of fiscal year 2025.
The entire prior year.
The entire prior year. That is a serious inflection point.
But let's get specific. You mentioned the physics problem earlier. What exactly is F5 doing for these AI customers? Is it just the hardware we talked about?
It's the application of that hardware. There are 3 main use cases they outlined. The first is what they call AI data delivery.
Okay.
Think about the throughput bottleneck. Companies are spending tens of millions on NVIDIA GPUs. Those chips are like Formula One engines. They're incredibly powerful, but they are also incredibly thirsty for fuel, which in this case is data.
And if you try to feed an F1 engine with a garden hose?
The engine stalls. If you can't get data to the GPU fast enough, the GPU sits idle. And an idle H100 chip is basically you just burning money.
So F5 solves that bottleneck.
They are the high-pressure fuel line, ensuring those expensive chips are running at 100% utilization.
Okay, that makes sense. You're protecting the investment in the GPUs. What's the second use case?
It's AI factory load balancing. And this involves a metric called time to first token.
Time to first token. I keep hearing this phrase. Break it down for the listener who isn't, an LLM engineer.
Sure. When you type a prompt into a model like ChatGPT, there's that little pause before it starts writing. That pause is the time to first token.
Right. The latency.
The latency between your request and the AI's first bit of output. In a corporate environment where you might have thousands of employees querying a model, that latency can spike and just kill productivity.
So F5 manages the traffic to keep that response time instant.
They balance the load across all the different model instances to minimize that delay. And the third piece is runtime security, protecting against things like prompt injection, beta leaks. They mention a major energy and chemicals company, a massive industrial player who moved from public AI tools to private models on-prem.
And they used F5.
They used F5 specifically to prevent timeouts and reduce latency. This is real infrastructure work, not just chatbots.
So AI isn't just about the smart software. It's about the plumbing that lets the software actually run without crashing.
It's the classic picks and shovels story, but for the data center age.
Okay, theme number 4, and this one feels a bit geopolitical, the digital sovereignty tailwind.
This was the sleeper hit of the quarter, I think. If you look at the regional breakdown, EMEA, so Europe, Middle East, Africa, their revenue grew 24%.
24%. That's massive outperformance compared to the Americas.
It is.
So why is Europe buying so much networking gear right now? I mean, is their economy booming?
Not necessarily the economy, but the regulation is booming. You have these mandates like NIS2 and DORA coming online.
Let's clarify those. We hear DORA a lot. What does it actually mean for a business?
DORA is the Digital Operational Resilience Act. It's an EU regulation. It effectively tells banks and financial institutions you cannot rely on a single point of failure.
Okay.
If your cloud provider goes down, you must have a backup plan that works immediately. You can't just shrug and tell the regulators, oh, sorry, AWS is down.
So it forces redundancy.
It forces redundancy. It mandates that you have failover capabilities, often requiring a split between the cloud and an on-premise infrastructure. This is what we call digital sovereignty. The idea that data has to stay within certain borders and be resilient.
So this isn't discretionary spending. This isn't the CTO saying, oh, it would be nice to have this. This is buy this box or pay a massive fine to the EU.
It's compliance spending. It forces immediate infrastructure upgrades. Management was very clear on the call. This is a durable driver. As long as globalization is fracturing and nations are demanding data stay local, companies have to build these redundant local systems.
And that requires F5 hardware to manage the traffic between those local silos.
That's the play.
Fascinating. So we've got the security bounce back, the hardware boon from cost-saving repatriation, AI infrastructure needs, and European regulation. That explains the beat. Now let's look forward. They raise guidance. How much?
They raised the full year 2026 revenue outlook to 5 to 6% growth. Previously, they were guiding to 0 to 4%.
That is a huge sentiment shift. I mean, going from potentially flat to solid growth completely changes the multiple on the stock.
It does, and the bottom line looks even better. EPS outlook was raised to a range of $15.65 to $16.05. The old midpoint was around $15.
And they lifted the operating margin target too, right?
Yep, to 34 to 35%.
So why now? Why is management so confident all of a sudden?
Because they see these drivers as structural, not temporary. The refresh cycle isn't just about replacing old boxes anymore. It's about expanding capacity. A customer isn't just swapping a 2020 unit for a 2026 unit. They're buying bigger, more powerful units to handle the AI workload we just discussed.
Okay, is there anything to worry about? I feel like we've been very bullish here.
Yeah.
Every earnings call has a fly in the ointment.
There is one specific risk to watch. The CFO, Cooper Warner, he flagged a headwind for the second half of the year. Memory component costs.
So inflation is back in the supply chain.
For memory, yeah. Costs are rising, and because of that, they did slightly lower the top end of their gross margin guidance. It's now 82.5 to 83.5%. It's a small tweak, and they're mitigating it with broker buys and qualifying new suppliers, but it shows the supply chain isn't perfectly smooth.
So margins might get a tiny haircut, but the volume is increasing enough to more than offset it.
That's the story, exactly. The bottom line here is execution. The company is executing well, the security hangover is gone, and they're capitalizing on the exact type of complexity hybrid cloud, AI, that requires their specific kind of plumbing.
It sounds like F5 has really found its groove again. Okay, we've covered the numbers, the narrative, the risks. Now it's time for everyone's favorite segment. Please remember, what you are about to hear is for entertainment purposes only.
This is absolutely not financial advice. Do not trade on this. We are just brainstorming based on the themes from the call.
But if you are a hedge fund analyst pitching a wild, high-conviction idea to your investment committee based only on this call, what's the trade?
All right. I call this trade the digital border guard, or maybe the heavy metal hedge.
The digital border guard. I like it. What's the play?
So here's the thesis. We are entering an era of data nationalism. The global internet is fracturing. Europe doesn't trust U.S. clouds. Asia wants to ring-fence their data. The days of the open, borderless internet are, they're fading fast.
Okay, slightly dystopian, but I follow you.
So the trade is this. You go long F5, ticker FFIV, and you pair it with a long position in European-centric data center REITs.
Okay.
But here's the kicker. You hedge it by shorting pure-play cloud storage companies, the ones that rely heavily on seamless cross-border data flows.
Whoa. So you are betting against the borderless cloud. That is a really contrarian take.
I am betting on friction. I'm betting that repatriation to on-prem hardware, that 37% growth number, is a signal that the cloud is becoming too expensive and too legally risky for global companies.
Right.
If data has to stay local to comply with DORA and NIST2, you need checkpoints, you need firewalls, you need load balancers that sit physically in Frankfurt or Paris, not virtually in Virginia.
So F5 sells the checkpoints for these new digital borders.
Exactly. In a world of digital walls, the guy selling the gates wins. If data has to stay secure and local, you need heavy metal, not just ephemeral software. That's the trade.
In a world of digital walls, the guy selling the gates wins. I love that imagery. And again, not financial advice, but definitely a provocative way to look at the geopolitical landscape of tech.
It's a play on complexity. F5 loves complexity. The messier the world gets, the more boxes they sell.
All right, let's wrap this up. F5 is back. Big beat, big raise, hardware is booming, and AI is actually generating invoices, not just press releases.
The market repriced them overnight because the fear is gone. Now they just have to keep executing against that raised guidance.
We will be watching to see if they can maintain that momentum through the rest of 2026. Check the charts, do your own research, and stay tuned for the next earnings breakdown.
Keep watching the tickers.